Welcome back, traders, and in today's video we are going to be discussing the sell-off that is currently taking place during this earnings season. We are going to be discussing the S&P 500 and the triple Qs to discuss the price actions that is currently taking place. My hope and my goal is so that way you can be better prepared for the next trading session. Without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Now let's get right into it. We are currently looking at the S&P 500, and as we can see from peak to trough, the peak being this day on July 27 was roughly around 459, and at the close of Thursday we are down 2% on the S&P 500. Looking at the triple Qs, we can see that from peak to trough, that was back here on the 19th, and that was roughly around this is 387 down to the close of Thursday, being a negative 3.65 percentage drop. Now, looking at these two percentages on the triple Q and on the S&P 500, this is not so alarming. More of a 5% drop would be something to be a little bit worried about. However, usually the market will recover after a 5% drop. However, nothing is 100% certain, which is why it is always good to hedge. And that is what we had done, hedging to the downside when we were seeing this peak around on mid-July. And so nothing can go up in a straight line. Likewise, nothing can go down in a straight line. There are always going to be rallies within a bear market and sell-offs during a bull market. And so the key is to be prepared on each end so that way you do not blow up on a trade. Now, what this whole sell-off was contributed to was the Fitch ratings downgrading the U.S. Treasury bonds from AAA to AA plus, and that was enough to cause a sell-off in the market. Now we noticed that there was an exchange of hands and something big was about to happen, because if we look intraday, what we noticed during the trading session on within the past 2 weeks, we noticed that the markets were starting to weaken, right? We noticed that midday we started to see massive sell-offs that we haven't seen in a while, right? So this was back here on the 14th of July. Also, we saw this big sell-off here. This was the 20th of July. And then right here from out of nowhere, roughly around 9 a.m., we had this 2% drop on the triple Qs. And then right here, this was August 1st. All of the evening session to the next morning, to the close of the day, we sold off 2 percentage points on the triple Qs. Now, the market prior to this big sell-off, this big drop, was already preparing to find an excuse to sell off. And so that is when we started to place hedges so that way we can lessen our losses. And once we can pick up a trend, if the trend was to move to the downside, that is where we started to take position and would profit in the direction of the trend. Now, trend trading is a very profitable strategy to do, because it is always easier to follow the trend once you can identify those spots in the market where trend is forming. You can identify where your stops are much more easier. Now, what we noticed, right, was several things that led up to this. One was those intraday sell-offs, and two was the weakening in the MACD. So the MACD is a momentum indicator, and as we can see, we saw a bearish divergence that took place on the June 22nd to the July 19th, right? So this two peaks here was the formation of a higher low. While the market was rallying, this is suggesting that there's not so many buyers that are interested at these levels where big, heavy hedge fund managers are starting to put their foot off the pedal for this rally that we have been seeing throughout this year, suggesting that buyers are starting to weaken and get out of the picture. And so we may be starting to see that formation of a new trend in the market, right? So as we can see, if we zoom in back here on the weekly chart, we can see this big trend form to the upside, right? We have these two big trend lines that are forming. Now, if we zoom in a little closer, we can start to see a change in trend where we have this higher low. And it was confirmed today, being that this was the low back here on the 24th of July, and on August 3rd, we finally created a new low back here at the on today's trading session. And so now we can start to figure out, well, if the trend is to the downside for the time being, right, the micro trend that we are seeing, well, where are our stops? Our stops can be identified in multiple areas. We can choose a tight stop down here at 380 on the triple Qs, and then we can also choose a 384 on the triple Qs, and then obviously the high back here. So these would be good stops if you want to trade to the downside, but remember, it's always good to sell pops during a bear market, as it allows you to be positioned for the best risk reward. So uh, today we decided to pick this point here. We saw that the market was weakening on the 15-minute chart, that it created a shooting star intraday. And so we picked this point here, and our tight stop, obviously, trading credit spreads, was going to be if the market would want to blow past this 380 level. So as long as if we were trading call credit spreads all the way at the top here and write these contracts, we were safe in the sense that we have so much margin of safety to the upside that the market will continue to stay within this channel here, and we would be protected just by selling calls alone, right? And it's vice versa. If you're trying to play to the upside, you want to find points where we can see what we call a hammer in the market, such as something like right here, where we can see a hammer in the market playing to the upside with a tight stop at the bottom, selling put credit spreads. And so, if you hedge correctly, you can put yourself in a position that is optimizing for good success in trading. And so that is what we are currently doing. Now, looking at the charts here, as if we can just pull the charts back and let's take a look at the daily chart on the triple Qs. Actually, let's take a look at the weekly chart here. Now, if we want to plot in different levels, let's clear this up here. Now that we have confirmed that we are in a micro downtrend, what we want to do next is to identify big levels of price action, right? And so obviously 380 is a big one because we see this confirmed back here. And as you know, like I already had these plotted on my default here. These are what I use intraday. And I'm just showing you how I got to this point here, which offers me risk reward levels that I trade off of. So I'm just going at this brand new back here on the charts, on the weekly chart here. So obviously you want to plot in this high, and we saw that this high was really correlated to the 387 level back here. We saw a lot of price action, especially with this wick here and this reversal. This was more of a trading range. It's not an exact science. So you kind of want to pull the charts back in that sense. Now, if we were to move a little further, we can see that there was a lot of support back here. Obviously, this 379 acted on this candle here was more of a resistance level, but as you can see, there's a lot of support back there. Now we want to look a little further because now that we know that we created a low of 372, we want to see how is that reacting in past history's price action. So we have this 370 here. That is the next level of support. We have this top wick here. And we can also use, let's actually move in a little closer. We can use this gap area here as another level of support and resistance, right? So this is now confirming that this was a area of resistance, or it's an area of resistance now, but it was an area of support back here from within July. So we can take these levels here and just work off of these. So what is the next move, right? That's something that you may be asking. Well, the next move is all it's all going to be dependent on how the narrative is going to play off from this point. We know that the market closed at 337 on the Nasdaq, and we have these levels here that we are going to be trading off of. Now, if the market decides to pull down, it may want to test this level several times before it moves down to the next level. The next level may be this 50 exponential moving average down here. And as we can see, there's a lot of price action that took place at this level. We can see that the levels was greatly respected in multiple instances. Back here from the July 6 to July 12, 11, and we can see that it was acting as a resistance back here. So there's a lot of volume traded in this area. And we can see that, within this range, if the market decides to fall back into this range, we are more than likely going to be trading these levels anywhere from 370 down to 360. This is the range that we are going to be trading in. However, it's yet to be confirmed. The way you want to determine what range you're trading in is how will the market react after this point. Obviously we have this downtrend, but if the market can hold this 370 level, then we are going to be continuing to trade between anywhere from 385 down to 375. This is the new range, right? And so we want to be able to determine how the price will trade within the next few days, so that way we can figure out levels of the market. At this point, whenever the market is very volatile, the key to survive is to reduce your size and to have cash on the side so that way you can deploy them whenever the risk reward is optimal for a greater chance of profitability. And so trading the range at the extreme points is the system that we are going to use at this point, being that the market is already being very volatile, right? Looking at the VIX, we've seen it make a high today at 1745. However, it closed the gap from the morning gap to where it is now, down to 15. The issue that we are having here, though, is that we are seeing momentum build up to the upside on the VIX, right? We saw back here on June, this crossover start to show us that, things are starting to pick up. The selling pressure might kick in at moment's notice. It's just going to need the right news to push the markets and flip the narrative to a more sellish standpoint, where bears can, pick up the pedal and take over the steering wheel of the market's trend. And so, you know, a 20 VIX is going to be very substantial. And if we see a 20 VIX, that may bring us all the way back to a more median outlook on the market. You know, reaching the 200 moving average on the market is going to be a bad uh, is going to be a bad sign for the market. However, the 200 moving average has been tested several times throughout the past few years, but with a strong uptrend, it may be a challenge to get to that point. But you know, the market is always going to be a mystery. It's very volatile in a sense, and no one knows where the market is going to go. All that you have control of is the entry points that you pick whenever you trade and how you manage your position sizing, right? That is the only thing that you have control over. We do not have control over the markets. The hedge funds are the ones that moves the markets. We don't know what's going to happen across the globe in Russia and Ukraine. We don't know what's going to happen at all. So the main thing that you have control over is how are you going to position size your trades and how are you going to pick your entry points. The goal is to pick levels in the market whenever we are starting to move sideways, and we need to pick levels that is going to offer us risk and reward. You know, positive positive reward, low risk setups. And so that is what we're looking at today, and how we are planning to trade this week to finish off the weekly candle. And as we can see, we are already looking weak on the weekly charts. This is the S&P 500, and if we close below the prior week's candle, that's going to be a big sign that things are really, really weakening, because the weekly candles tell a lot more of what is going on in the markets. So looking at the triple Qs, we have the exact same thing. We are probably going to be closing low on this week, given that tomorrow is the last trading session of the week. So it's important to see how this week closes, as it may shift the narrative of the overall stock market. So if you enjoyed this video, please go ahead and like the video down below. Please go ahead and subscribe to the channel, and we will see you on the next one.